to be chatting all about tax brackets, which has been a really popular topic. It always comes up. There's a ton of misinformation. So I'm going to go ahead and grab my glow in the dark witch mug and we're going to go ahead and get started here. So this is relevant to you whether you're a freelancer, you're an LLC, you have an S-Corp election, your business income will always eventually show up on your personal tax return in some way, shape, or form. So when your revenue grows, your personal taxes end up shifting as well. The question's not whether that's good or bad, it's whether you understand what's changing and you're not unintentionally making moves that may impact you in a negative light. So we're going to chit chat all about how progressive tax brackets are structured, what moving into a higher tax bracket actually means. You'll understand why earning more doesn't mean that all of your income is taxed at the highest rate, and how income is taxed in layers when it's progressive, not in all one big percentage. So let's go ahead and dive in. Not all of your income is taxed the same. So we're going to look at a couple of different examples here. We're going to use this as an example. Alex is a wedding planner for business and profit taxable income. We're going to say $180,000, and we're going to keep things simple. We're going to use a single for the filing status for simplicity's sake. And what a lot of people will end up doing is go, oh my gosh, I made 180,000. Like look at the tax bracket and go, all of it's being taxed at 24%. We're only talking about federal at this level as well, because states can vary, which we'll briefly touch on. That's not right. That's just your highest tax bracket. So federal income taxes, you are taxed progressively. And so I was explaining this a couple of weeks ago, and I was thinking about it in terms of like a cake layer where you have, your first approximately $12,000. And this changes every year because these tax brackets shift as life gets more expensive. They shift a little bit with each year. So these will change from year to year. Think of your income as being stacked in layers, not in one bucket. So progressive tax rates, your first $12,000 of taxable income taxed at 10%. The next $38,000 of taxable income is taxed at 12%. The next $55,000 is taxed at 22%. And then remaining $75,000 in the example that we gave is taxed at 24%. That does not mean that the second you hit that 24% income level, that everything is being retroactively taxed at 24%. It's only the amount that's in that bracket. So be thinking of that when it comes to progressive. Now, what you may not be aware of is that sometimes if you have state income tax, a lot of states also have progressive rates like the IRS. Oregon is one of them. California is one of them. Colorado, and I believe Arizona, Colorado for sure, though, are both example of flat taxes. Colorado, I believe, has a flat tax as of, I think, 2025 of 4.4%. So that is just a flat, you pay that percentage of what you make. So you can understand here where maybe you hit that 24% bracket and you're like, oh, I really want to avoid it. And you'll see it with traditional jobs as well. Like, oh, I don't want to hit a bonus, or I don't want to get this. People are actively turning money away because they think they're paying more in taxes. Also, it would be better in both of these examples for you to make an extra $10,000, pay 24% in taxes instead of 22% in taxes, and walk away with more money. You're still pocketing more money at the end of the day. Now, let's talk about same business profit, different tax outcome. We're going to walk through two different scenarios here for Jamie: sole prop and a single member LLC or an S-Corp. Now, keep in mind, this doesn't change your income taxes, and you'll see that in here. So S elections, there's a really common misconception that S elections do not, or help you save on taxes, but they're not specific, and that they help you save on your self-employment taxes. They don't actually make a difference on your income taxes. So when you go and you file your taxes, you actually have multiple potential taxes in there. You'll have payroll taxes, you'll have income taxes, you can have capital gains taxes. There's all these different things but you get to the end of the tax return and it's like, oh, you owe this. People equate that generally with just income taxes, when in reality, for many of us, it is a multitude of taxes all in one. So in this example, $185,000 in taxable income as a sole proprietor or a single member LLC, all of that $185,000 is subject to income tax, which is what we just talked about, right? That tiered cake plus state taxes if you have it. And love being self-employed. All of that is also subject to self-employment tax of approximately 15.3%. Those are payroll taxes. That's Medicare, FICA, FUTA, Social Security, etc. If you were traditionally employed by a job that gave you a W-2, you would pay half of those. You'd pay 7.65%, and your employer would pay half of them because you are both your employer and your employee. You pay it the whole 15.3%. So you can see how on a $185,000 tax bill, not factoring in income taxes, that's $28,000 just in payroll taxes, right? On this $185,000. That's why people that are self-employed normally are like, oh my, like, why am I paying so much in taxes? Because it's not just income taxes, it's also your self-employment or your payroll taxes, which I'll use those interchangeably. Now, this is an S-Corp example. Exact same taxable income, total of 185. But we've divided this into two buckets now. Jamie's salary, which would be a W-2, and then owner's distributions, which is just them taking money from the business and paying themselves like they've been doing, assuming they had separate business accounts here. So in this example, only the salary is subject to the payroll taxes, this 15.3%. The distributions, the $105,000, are not subject to self-employment tax. And that saves actually a little over because we're at 105,000 here. But if you take 105,000 times 15.3%, $16,065 in approximate savings. Now, there are some things to keep in mind. You have to pay for payroll. You need to run payroll when you have an S election. That's an added cost every year. You have a separate set of business returns that are due in March instead of in April. That's generally an extra fee. You have to make sure you're paying yourself a reasonable salary. You can't pay yourself $20,000 if you're working full time and you're living in San Francisco. That's not a reasonable salary. I'm not saying $80,000 is. It really depends on where you're at. In some places, depending on your work schedule, your cost of living, your industry, $40,000 salary could make sense. In some places, it may need to be $150,000 salary in order to make sense. So it could be the exact same business, the exact same profitability, but you drop it into different cost of living areas or different amount of work hours, different tiers, right? You could have like luxury photography versus, that's working 20 hours a week. You could have someone that is, kind of mid-range photography that might be working 35 hours a week. Those can be completely different situations here, but that's an estimated, $16,000 in savings per year with the exact same profit. The only difference here is you have to be an LLC or a corporation with an S election laid over the top of it. And if you have questions about whether you think it might be time to look at an S election, you're always welcome to reach out to us and ask follow-ups on that, because there's a lot that goes into it and you want to make sure that you are saving more than you're paying and that you're honestly able to dedicate the amount of time, which it's not a ton of time, but you need to be organized. Your tax returns need to be on time. You need to have your business expenses separated from your personal. Like there are just some more hoops that come with it, but they can come with some really substantial savings. So salary versus draws versus investments for Taylor, who's a wedding florist studio owner. And we're going to say that her business profit / taxable income is $150,000. We're going to walk through two scenarios for Taylor. So number one, takes all $150,000 as spendable cash. All of it is taxable. You get taxed on your profit, whether you take it out of the business or not. So you get to the end of the year, it's, your income's $200,000, your expenses are $50,000. For simplicity's sake, your taxable income is $150,000. That means that you are getting taxed on all of it, even if it sits in that business bank account and you don't pull it, which is a common misconception. Plus, you're also paying self-employment taxes, all that jazz, right? Now, let's say that you have an intentional mix here. You have a reasonable salary if you're an S-Corp. You have some distributions above and beyond that. You take $25,000 of that profit and you invest it into a retirement account, pre-tax, which means you're not paying tax on it now. You're paying tax on it when you withdraw it. Equipment upgrades, which means you're not paying tax on it now, and or business reinvestment, maybe a business coach, maybe a website revamp, maybe branding. All of that can provide a lower taxable income because the retirement, the equipment upgrade, and the business investment all reduce your taxable income, so it would drop you below 150. If you have a reasonable salary because you're an S-Corp, that's going to be reducing your taxable income, right? Because you're paying less in self-employment or payroll taxes. You're going to be building wealth because you're putting money into your retirement accounts. and your business is stronger next year. So these are all, in an ideal world, this would be a better mix, but we have to make sure that you're understanding what you need to be making and earning first, because the world is expensive. Life is expensive. And it can be really easy to have all this whole $150,000 spent or taxed, I should say, whether it's spent or not, personally, and not really have as much to show for it. Like you could have a really great personal life, but maybe you have no retirement, maybe you have no savings, maybe you have, equipment that needs to be upgraded and you don't have a plan for how you're spending it. And so this really comes back to an intentional mix. And something that we talk a lot about with our clients is maybe you have a higher taxable year expected for 2026 in this example. Maybe in 2027, you're changing how things work. You're planning to take fewer weddings. You're, planning to have a baby. You're planning to take longer vacations. Let's just say that you have a lower taxable income year planned for the next year. It would potentially make sense then for you to make strategic money moves in this year when you're at a higher tax bracket, because those investments, those retirement account contributions, all of these things, your equipment upgrades can all make a bigger difference this year because you're at a higher tax rate than they would if you did those exact same purchases in a lower taxable income year. Same thing, if maybe 2025 was a lower income year, maybe you held off on purchasing a new camera body or a new Apple computer until January of 2026, because it'll give you more bang for your buck. It'll give you more tax savings for the exact same spend. So a reminder here, taxes are not a punishment for success. They're the result of unintentional structure. I'm here to bring the intention back to it, the planning back to it, so that you're not getting to the end of the year and going, I have no idea where this came from. Our entire team is here to help you be able to plan for this and to help you be able to make moves that feel aligned with your business goals, your personal goals, and to help move you toward what your ideal life and business look like.
That's a wrap for this episode of the Wealth Witches podcast. I hope our magical money talks have left you feeling empowered and inspired. Remember, wealth isn't just about dollars in the bank, it's about abundance and financial freedom in all aspects of your life. I'm Katelyn Magnuson, encouraging you to keep challenging the status quo and embrace your inner witch on this financial journey. Until next time, stay magical.